Today, we're going to do a deep dive into the Sortino ratio.
Okay.
Now, this might sound a bit technical, but trust me, it's a concept that can make a real difference in your investment journey.
Great.
In a nutshell, the Sortino ratio helps you understand how much return you're getting for the downside risk you're taking on. That's the risk of losing money.
Mm-hmm.
And as you know, that's something we all want to avoid as much as possible.
For sure. For sure.
So to help us break this down today, we're joined by our expert.
Hi.
So maybe you can start by telling us, what is the Sortino ratio all about? Why is it so important for investors?
Well, the Sortino ratio is all about looking at risk in a more intelligent way. Instead of just kind of lumping all volatility together, good and bad, it focuses specifically on the downside, the part that really matters to investors.
That makes a lot of sense.
Yeah.
So how does this Sortino ratio actually work? What are the key ingredients?
So the Sortino ratio starts with your portfolio return. That's the overall gain or loss you've experienced. We then subtract the risk-free rate, which is typically represented by the return on a U.S. Treasury bill considered a very safe investment. This difference gives us what we call the excess return, the reward you're getting for taking on the risk.
Okay, so it's like comparing how much better our investment did compared to just putting our money in a safe, boring treasury bill.
Exactly. And then we divide that excess return by what's called the downside deviation. This is where the Sortino ratio truly shines. Instead of using standard deviation, which considers all volatility, it focuses solely on the volatility below a specific target, which we call the minimum acceptable return, or MAR.
So we're essentially filtering out the noise and focusing on the bad volatility, the part that can really hurt our portfolio.
Precisely. And the beauty of the Sortino ratio is that it gives you a single number that captures this risk-adjusted performance. A higher Sortino ratio generally indicates a better investment, meaning you're getting more return for each unit of downside risk you're taking on.
This is starting to make a lot of sense. But before we go any further, can you give us a simple example of how this downside deviation is actually calculated? I mean, how do we actually measure this so-called bad volatility?
Sure. Let's say we're looking at an investment's monthly returns over the past year. And for simplicity, let's assume our minimum acceptable return, our MAR, is 0%. That means we're only concerned with the months where the investment lost money.
So we're essentially isolating the negative returns. What's the next step?
For each of those negative returns, we calculate how far it deviated from our MAR, which in this case is 0%. Then we square each of these deviations, add them up, and divide by the total number of months. Finally, we take the square root of this average to get what's called the downside deviation.
So it's like finding the average distance those negative returns are from our target, but with a bit of math thrown in to make it more accurate.
You got it. And if you're comfortable with formulas, the downside deviation can be expressed mathematically as the square root of the sum of the square deviations below the MAR divided by the number of periods.
I appreciate the formula. But your explanation definitely helped me visualize what's going on. So now that we understand how downside deviation is calculated, why is it so important to use it instead of the more familiar standard deviation? What are the real advantages here?
Well, standard deviation, while a common risk measure doesn't always reflect the kind of risk that truly matters to investors, it considers both upside and downside volatility equally. And this can sometimes distort the true risk picture, especially for investments that don't follow a nice symmetrical pattern.
So it's like using a tool that's not quite the right fit for the job.
Exactly. Downside deviation, on the other hand, zeroes in on the risk that keeps investors up at night, the potential for losses. It aligns better with how we actually perceive risk.
It's a more intuitive way to look at risk, one that acknowledges that losses hurt more than gains feel good.
Precisely. And this is particularly relevant for investments with asymmetric returns, like options or certain alternative investments, where the potential for both large gains and significant losses exists. In these cases, downside deviation gives you a much more accurate assessment of the real risk you're taking on.
So it sounds like the Sortino ratio is a valuable tool for any investor who's serious about understanding and managing risk. It's like having a secret weapon in your investment toolkit. But before we get too carried away, are there any limitations to the Sortino ratio that we should be aware of?
Yeah, the Sortino ratio is a very useful tool, but like any tool, it has limitations.
Yeah.
One thing to keep in mind is that it relies on historical data. We're looking at past returns to calculate downside deviation. And as we know, past performance is not always a reliable predictor of future results.
Right. The market can be unpredictable, and what worked well in the past might not work so well in the future.
Exactly. So while the Sortino ratio can give you valuable insights into an investment's historical risk-adjusted performance, it's important to consider other factors as well. Things like, changes in market conditions, the investment's underlying fundamentals, and any economic or geopolitical events that could impact its future performance.
So it's about using the Sortino ratio as part of a broader investment analysis process, not relying on it as a sole indicator.
Precisely. The Sortino ratio is a powerful tool, but it's most effective when used in conjunction with other analytical tools and a thorough understanding of the investment landscape.
That makes a lot of sense. Now, you mentioned earlier that the Sortino ratio is particularly useful for investments with what you called asymmetric returns, like options. Can you elaborate on that a bit more?
Of course, asymmetric returns basically mean that the potential gains and losses are not balanced. Options, for example, can offer the potential for large gains if the underlying asset moves in the right direction, but they can also result in significant losses if the asset moves against you.
So the risk and reward profile is skewed in a particular direction.
Exactly. Standard deviation, which treats all volatility equally, wouldn't capture this nuance. But the Sortino ratio, by focusing specifically on downside deviations, provides a much more accurate assessment of the real risk involved in these types of investments.
It's like having a risk measure that's tailored to the specific characteristics of the investment rather than a one-size-fits-all approach.
Precisely. And that's one of the key advantages of the Sortino ratio. It allows us to compare investments with different risk profiles and return characteristics on a more level playing field.
This is incredibly valuable. I'm
Yeah.
starting to see how the Sortino ratio can really empower investors to make smarter choices. It's not just about avoiding risk altogether. It's about understanding the different types of risk and finding investments that align with our individual risk tolerance and investment goals.
Absolutely. The Sortino ratio encourages a more thoughtful and strategic approach to risk management. It helps us move beyond simplistic notions of risk and return and delve deeper into the nuances of different investment strategies. It allows us to see beyond the surface and make more informed decisions based on a deeper understanding of risk and reward. Now, you might be wondering how the Sortino ratio applies to more complex investments like hedge funds, which sometimes aim to generate positive returns regardless of market direction.
So they're not just riding the market waves, they're actively trying to create their own opportunities.
Exactly. They might use techniques like short selling or leverage to try to profit even when the market is declining. Now, if we were to evaluate these investments using standard deviation, it might give us a misleading picture of their risk.
Because standard deviation would penalize them for any volatility, even if those fluctuations were part of their strategy to make money in different market conditions.
Precisely. The Sortino ratio understands that not all volatility is bad. It focuses on the downside deviations, those instances where returns fall below our minimum acceptable return. So for these alternative investments, the Sortino ratio can provide a much more accurate picture of risk-adjusted performance. And that's one of the key strengths of the Sortino ratio. It allows us to compare investments with different risk profiles and return characteristics on a more level playing field.
It's not just about avoiding risk altogether. It's about understanding the different types of risk and finding investments that align with our individual risk tolerance and investment goals. Now, I'm curious to see how this all plays out in real-world scenarios. Could you walk us through some specific examples of how the Sortino ratio can be used?
Certainly. Let's consider a scenario where you are evaluating two mutual funds. Fund A boasts an impressive average annual return of 12% over the past 5 years, but it has also experienced some significant losses, with its biggest loss being 8% in a single year. Fund B, on the other hand, has a more modest average annual return of 8% over the same period, but its maximum loss has been limited to 3%.
Now, if we were just looking at returns, Fund A would seem like the clear winner. But as we've learned today, returns are only part of the story. We need to consider risk as well, and that's where the Sortino ratio comes in.
Exactly. If we calculate the Sortino ratios for both funds using a minimum acceptable return of perhaps 5%, we might find that Fund B actually has higher Sortino ratio than Fund A. This would indicate that despite its lower average return, Fund B has delivered a better risk-adjusted performance, particularly for investors who are more sensitive to downside volatility.
I like that. Can you give us another example?
Certainly. Let's say you're thinking about adding an alternative investment to your portfolio, such as real estate or a private equity fund. These types of investments often come with the potential for higher returns, but also carry unique risks that might not be fully captured by traditional risk measures like standard deviation. The Sortino ratio, by focusing on downside risk, can provide a more insightful assessment of the true risk-adjusted performance of these alternative investments. It can help you determine whether the potential rewards outweigh the downside risks, given your individual investment objectives and risk appetite.
Are there any other practical applications of the Sortino ratio that we might find useful?
Absolutely. The Sortino ratio can also be used to compare the performance of different portfolio managers or investment strategies. For example, if you're evaluating two hedge fund managers, you can use the Sortino ratio to assess which manager has historically delivered a better risk-adjusted return given their respective investment approaches and risk profiles.
So it's not just about comparing individual investments. It can also be used to evaluate the skill and risk management capabilities of different investment professionals.
Precisely. The Sortino ratio provides a more comprehensive and nuanced view of performance, going beyond simple returns to consider the downside risks that investors face.
I feel like I've gained a powerful new tool and a whole new perspective on risk management. Any final thoughts or words of wisdom for me as I embark on my investment journey?
Remember, investing is a marathon, not a sprint. It's about making informed decisions, managing risk effectively, and staying focused on your long-term goals. The Sortino ratio is just one tool among many, but it's a valuable tool that can help you navigate the complexities of the market with greater confidence and clarity.
Excellent advice. Well, there you have it. The Sortino ratio demystified. We've explored its definition, calculation advantages, limitations, and practical applications. I feel empowered to incorporate the Sortino ratio into my investment analysis process. Thanks for joining me on this deep dive.